Imagine if every geopolitical analysis and economic prediction you've heard in the past few weeks proved to be 100% accurate. From the final score of the 2026 World Cup to the brutal spike in global oil prices. This time, I will reveal a financial navigation roadmap that will not only protect your wealth from the devastation of a global crisis, but also hand you the golden key to multiplying your assets amidst world chaos. Stay with me, Rizman from softbank.id, because the strategies we are going to dissect today could be the difference between merely surviving or printing the biggest record profits in your portfolio. Prediction accuracy, from the world stage to the energy market. Hello everyone, it's great to be able to greet you all again. This time, we have some very exciting news to discuss together. If you paid attention to the analysis I shared a month ago, you know how thrilled I am watching the dynamics of the recently concluded 2026 World Cup. Personally, I am a massive fan of Lionel Messi and really hoped Argentina could defend their championship title. However, as an analyst, objective data and calculations do not lie. Long before the tournament even started, I had already predicted that Spain would emerge as the ultimate champion. And it was proven right. The final match pitted Spain against Argentina. Even though my heart wanted to see Messi lift the trophy one more time, the facts on the pitch confirmed my mathematical prediction. Spain won narrowly, 1-0, and officially won the 2026 World Cup. But the real surprise wasn't just on the green field. The geopolitical and energy market predictions I delivered last week also became a reality. During my interview with leading European media a few days ago, I warned the world. Get ready, in less than 10 days, global crude oil prices will break through $90 per barrel. Today, that prophecy has officially come to pass. For countries or investors who are unprepared, this situation is a nightmare leading straight to bankruptcy. But for those of us who know how to read the wind, this is the ultimate momentum to print massive profits. The Strait of Hormuz drama, when security tariffs become thug taxes. Let's dissect what is actually happening in the Strait of Hormuz that triggered this oil price surge. US President Donald Trump threw out a controversial idea by demanding a 20% tariff for every oil cargo passing through the Strait of Hormuz, under the pretext of a security guarantee fee. Many people don't realize just how absurd and crazy that 20% figure is when calculated in US dollars. Iran's tariff scheme. Iran sets a fixed rate of $2 million per passing supertanker. Vessel capacity and cargo value. An average very large crude carrier, VLCC, transports 2 million barrels of crude oil. When oil is around $80 per barrel, the total cargo value in a single ship reaches $160 million. Number comparison. The $2 million tariff from Iran is actually less than 2% of the ship's total cargo value. Donald Trump's 20% scheme. If the US imposes a 20% tariff on the $160 million cargo, every ship would have to pay around $32 million per crossing. This $32 million figure is 16 times more expensive than the tariff demanded by Iran. It is no wonder this policy earned Trump the nickname Captain Donald Sparrow in international shipping lanes. As a result of this brutal policy, ship owners are trapped in a deadly dilemma. If they pay for US security services, their ships still risk being targeted by Iranian missiles. Conversely, if they pay Iran, they will face sanctions and the US military fleet. Ship owners are threatened with double payments and extraordinary losses. Fierce backlash immediately poured in from close US allies. The UK publicly stated its disagreement, calling the 20% tariff in the Strait of Hormuz completely unreasonable. The United Nations, UN, also firmly rejected it, judging that the US move violates the principle of freedom of navigation, a principle the US and its allies have constantly championed when criticizing military patrol activities in other international waters. Although Trump eventually softened and canceled the tariff discourse, tensions in the Strait of Hormuz were already blazing. Military escalation and supply shortages. That provocative statement instantly triggered an explosion of real conflict on the ground. Two supertankers, the Albaya and the Mombasa, fell victim to attacks while sailing just 13 nautical miles off the coast of Oman. The impacts have been fatal. Shipping traffic plunged. Before the conflict heated up, the Strait of Hormuz was crossed by an average of 138 ships per day. Post-attack, the number of ships daring to cross has drastically plummeted to just 4 ships per day. Expansion of the conflict area. Iran has begun striking facilities in Bahrain. The conflict has also spread to Yemen, where Saudi Arabian airstrikes on a Yemeni airport triggered retaliatory missile strikes from Houthi groups into Saudi territory. Non-stop bombardment. The U.S. responded by launching airstrikes for 9 consecutive days on hundreds of strategic targets in Iran, ranging from underground bunkers and weapons depots to drone assembly plants. These conditions have forced Iran into a tight corner where diplomatic negotiation is no longer an option. Iran is being pushed to activate its entire global network of sympathizers and sleeper cells, which has the potential to turn this localized crisis into an all-out war. 3 key points of advanced financial analysis, 2026 update. Looking at the increasingly heated geopolitical situation heading toward the threat of $100 per barrel oil prices, there are 3 crucial discussions you must pay attention to in the current economic landscape. 1. Macroeconomic implications for India and the Strategic Petroleum Reserve, SPR. As the 3rd largest crude oil importer in the world, India is on the front lines of this crisis. The government in New Delhi must now rack its brains to manage its Strategic Petroleum Reserve, SPR. Oil prices rising above $90 to $100 per barrel will directly inflate India's current account deficit and pressure the local currency against the US dollar. If the crisis continues, India will be forced to find alternative payment schemes, such as a rupee-real mechanism or non-USD currency options, and accelerate the diversification of oil supplies from non-Middle Eastern regions to stem the tide of domestic fuel inflation. 2. Shift in global logistics routes via the Cape of Good Hope. The paralysis of the Strait of Hormuz and the Red Sea is forcing global shipping giants to avoid the shortest canal routes and reroute their tankers around the southern tip of Africa, the Cape of Good Hope. This rerouting adds 10 to 14 days to the voyage, which directly impacts a surge in container freight rates of over 300%, skyrocketing maritime travel insurance premiums, sudden global commodity supply shortages, supply chain bottlenecks, which will ultimately be passed on to end consumers in the form of rising prices for basic goods. 3. Capital market mapping, winning issuers versus affected sectors. In every crisis, there are always losers and winners. As a smart investor, you must be able to sort your stock portfolio wisely. Beneficiaries, winners, underperformers, negatively affected. Upstream oil and gas. Exploration and production companies as sales margins are boosted. Aviation and land logistics. Due to swelling operational fuel costs, after/fuel. Defense industry, global military manufacturing and arms suppliers. Manufacturing and FMCG, sectors heavily reliant on high-cost imported raw materials. Shipping lines, tanker service providers enjoying a surge in vessel charter spot rates. Closing from Risman. The world is indeed not okay, but chaos always brings opportunities for those who are prepared and possess the right information. The surge in oil prices toward $100 per barrel is no longer just a possibility, but a certainty unfolding right before our eyes. Consider carefully what strategic steps India must take to face this global energy crisis, and evaluate which sectors are currently the main focus in your investment portfolio. I'm Rizman from softbank.id. Thank you for tuning in to this analysis until the end. Stay rational in your investment decisions, guard your portfolio with strict risk management, and see you in the next strategy review.